There are a lot of different investment options out there to choose from. Growth stocks, dividend stocks, T-bills, bonds, mutual funds, etc. And it can be difficult to make a sound investment choice for your retirement nest egg, especially when you have real life to deal with on a daily basis. So here are 3 straightforward, simple investing strategies for the average Joe investor that you can implement today. We're going to start with the most simple and basic approach and then build from that point. But just know that all 3 of these investment options are simple and can absolutely be implemented by any average Joe investor. Furthermore, none of these investments are better than the other. It's all about finding the right investment fit, given how involved you want to be in the process. This is by far the easiest and most hands-off approach to invest. Simply choose an investment one time and then set it and forget it. Target date funds are set up so that you never need to adjust the investments in your portfolio. This is done for you over time. The generally agreed to principle with investing is that you should be aggressive with your investments when you are younger, and as you get older, your investments should become more conservative. In real life, this means that you are fully invested in the stock market when you are young, and then as you get older, you add in bond investments to reduce the risk of a large market crash cratering your retirement timeline. Target date funds automate the process for you. They create a mix of index funds and bond funds based on the year you want to retire. Then, every year you continue to invest in the fund, they slowly adjust the investments to make them more conservative. It's a completely hassle-free process. You can purchase target date funds from many different investment companies, but by far the 2 most common investment companies are Vanguard and Fidelity. Vanguard calls these funds target retirement funds, and Fidelity calls them freedom funds. However, they are the exact same type of investment. Let's take a look at an example. We're going to look at a 2050 target date fund for both Vanguard and Fidelity. For Vanguard, we have the Vanguard Target Retirement 2050 Fund, ticker symbol VFIFX. And for Fidelity, the Fidelity Freedom Index 2050 Fund Investor Class, ticker symbol FIPFX. Now, first thing we'll notice here is that the expense ratios are different. For Fidelity, we have 0.12% annually, and for Vanguard, we have 0.08%. Vanguard also requires a $1,000 minimum initial investment, whereas Fidelity does not require any initial minimum to invest. In looking at the underlying portfolio composition, you'll notice that for Fidelity, 55.6% of the fund is U.S. equities made up of a Fidelity Total Market Index fund. An additional 35% is made up of non-U.S. equities, meaning an international stock fund. Then about 9.2% is in bonds, and then a small amount of cash. And then for Vanguard, we see 53.3% in the Vanguard Total Stock Market, aka U.S. stocks. Then 37.3% international stocks, 6.6% US bonds, 2.8% international bonds. Very similar compositions, though you do see a little bit more international exposure with Vanguard. Okay, so what are the pros to holding a target date fund? Well, it's hassle-free. Set it and forget it. You can simply contribute money every month to your retirement account, and you are good to go. You literally do not need to take any additional actions from the time you start investing until the time you're ready to retire. So what are the downsides to this strategy? Number 1, you are giving up the flexibility to select your own investments. If you prefer to be more aggressive or you prefer to be more conservative, you cannot adjust the investments in the fund. Number 2, investment allocation. With the Target Date 2050 fund, we are 28 years away from retirement, which is a long time, and yet we still have 8 to 10% of assets in cash or bonds. This seems ridiculous to me, but again, this is the nature of how target date funds work. Number 3, and this is a minor issue, but you have slightly elevated expense ratios with these target date funds. Now, 0.12% for Fidelity and 0.08% for Vanguard is not a high expense ratio, but it is 3 to 4 times higher than just holding a single low-cost index fund, such as the S&P 500 index fund. But then again, this is such a minor fee when you factor in the value you get and the time you save by not having to manage your own investments. Now, this is my personal favorite among the 3 investment strategies. It is so simple. Invest in a single index fund or ETF that tracks the stock market. In fact, this is exactly what I do in my own retirement accounts. Whether it's my 401k account with my employer, my Roth IRA, or my health savings account. All of them hold a single investment, either the S&P 500 or the total stock market. You can choose either the S&P 500 or you can hold a total stock market index fund in your own accounts. Here are a few examples. The SPDR S&P 500 ETF Trust, or SPY from State Street, and the Vanguard S&P 500 ETF, ticker symbol VOO, are great S&P 500 ETFs. And then you have the Vanguard Total Stock Market ETF, ticker symbol VTI, which is a total market ETF. If you prefer an indexed mutual fund, you have the Vanguard 500 Index Fund Admiral Shares, VFIAX, or the Fidelity S&P 500 Index Fund, ticker symbol FXAIX. Both of these track the S&P 500 index, and if you want a total stock market index fund, you've got VTSAX from Vanguard, and the Fidelity Total Market Index Fund from Fidelity, FSKAX. These are highly diversified investment options that will perform well over the long term. So what are the pros to this strategy? Well, it's super simple and you get great returns over the long term. Additionally, all of these investment options have ultra low expense ratios. Literally fractions of pennies on the dollar. What's the downside to this strategy? Well, number one, eventually, down the road, you will need to adjust your portfolio, as this strategy is great when you are young and even when you are middle-aged, but it's a very risky strategy when you are closing in on retirement or are actually retired. You would want a more conservative approach at this stage of retirement. Additionally, you can expect to see more volatility in your investments with this strategy. That's not necessarily a problem though, unless you are very uncomfortable with seeing wide swings in the balance of the investment at times, or if you are close to retirement. This strategy takes the most effort of the three different strategies, but also gives you the most flexibility and control. In this strategy, you take complete control of your investments and hold anywhere from 2 to 5 different index funds or ETFs. What this strategy does is allow you to diversify your investments across multiple asset classes and gives you the control to adjust your investments over time based on your comfort level. When I say multiple asset classes, I mean stocks here in the US and stocks from around the world, bonds here in the US and international bonds, commodities, and more. So what are the pros to this strategy? Number one, control. You have complete control over your investment strategy and you can adjust your investment allocation over time based on your investment preferences. Number two, you are highly diversified across multiple asset classes. What are the cons to this strategy? Well, it takes more work. You are in control, 100% complete control of the investment options and making sure you rebalance as necessary over time. You also have to make sure you are up to date on how your investments are performing. Now, the investment choice that makes the most sense to you will depend on how much effort you want to put into your portfolio. The good news is this is 2022 and investments are cheaper than ever to hold in your portfolio. Whether you want a completely hands-off approach like target date funds, prefer to take complete control, or something in between, there is a strategy that fits your preferences. Make sure to leave your 2 cents down in the comments below as I respond to all comments received on the day I post a video. That's all I got for you guys. Have a great rest of your day and thanks for watching.